Have you ever wanted to, like, just print your own money?
Oh, absolutely. I mean, who hasn't?
Right. You look at your wallet, maybe it's a little light, and you just think, I could just design my own bills, slap a picture of my dog on a 20, hand it to the barista, and just call it a day.
It's the ultimate financial fantasy. But historically speaking, people have actually tried it to solve very real local economic problems.
And today, we are going to look at what happens when people actually do it, and how that very simple urge to control our own currency has evolved into something that is literally rewiring the global financial system. So welcome to the deep dive.
We have a massive stack of research to get through today.
We really do. We're taking you on a journey through, well, everything from a fascinating Wikipedia page on a hyper-local Massachusetts currency to a really dense Federal Reserve staff report from February 2026.
Plus some technical breakdowns from Voltage and Trezor on blockchain plumbing.
Yeah, and global regulatory guides from Bitwage and Scadden, and even a press release from the European Central Bank. Our mission today is to explore this massive, quiet revolution happening to the concept of money.
Right, tracking that shift from physical local bills to global digital stablecoins.
Exactly. And how these innovations are accidentally breaking and rewiring the traditional banking system. Okay, let's unpack this.
Sounds good.
Starting with the physical paper.
Yeah, so to understand the massive digital systems running the world today, we kind of have to look at the core motivation for creating alternative money in the first place.
Which is what? Exactly.
Well, it's usually about keeping value trapped within a specific community. And a perfect case study for this is a currency called BerkShares.
BerkShares. Yeah, I had actually never heard of this before, but it is so fascinating. The Berkshires is a region in Massachusetts, right?
Yes, exactly.
And back in September of 2006, they launched their own local currency.
They did. And this wasn't like some novelty item or a tourist souvenir. It was an actual circulating local currency designed to stimulate a very specific geographic area.
Oh, wow.
Yeah, and as of 2024, there are 6 offices across 2 local banks where anyone can walk in and exchange U.S. dollars for BerkShares at a 1-to-1 rate.
And over 300 local businesses actually accept them.
Right.
And the physical bills themselves are beautifully printed. They feature local heroes like a Mohican tribe member, W.E.B. Du Bois, Herman Melville, Norman Rockwell.
It really connects the money to the community.
It does. But what really caught my eye in the research wasn't the art. It was the clever psychological trap built into the economics of it.
Ah, yes.
There is a catch when you decide you want your regular U.S. dollars back.
That is the linchpin of the whole system. When you buy BerkShares, the exchange rate is 1-to-1. You give the bank $1, you get a Berkshire.
Right.
But if a business owner takes those BerkShares back to the bank to convert them into U.S. dollars, the bank charges a 1.5% exchange fee.
Which completely flips the incentives. It basically acts like a town-wide gift card.
That's a great way to put it.
Once you convert your cash, you are financially locked into that local ecosystem. Just think about the psychology here. If you are a local baker and someone pays you 50 BerkShares for a large order, you do not want to take that 1.5% penalty at the bank.
No, of course not. So you look for ways to spend it within the network. You use those BerkShares to pay the local plumber who fixed your sink.
And the plumber doesn't want to take the penalty either, so they use those BerkShares to buy groceries at the local market.
Exactly. Economists call this the multiplier effect.
The multiplier effect.
Yeah, the penalty creates this sort of hot potato dynamic where the money just keeps circulating locally, which is fantastic for those specific businesses.
It forces economic loyalty.
Right. But what's fascinating here is that it also exposes the fatal flaw of physical alternative money.
Which is?
It fundamentally cannot scale. It relies entirely on absolute trust in a tiny, localized network of specific banks and specific merchants.
Yeah, I mean, you can't hand a paper Berkshire to someone in Tokyo and expect to buy a coffee. It only works if you never leave the county.
Precisely. Because local currencies are geographically trapped by their physical nature, the internet inevitably stepped in to invent a borderless alternative.
A stablecoin.
Exactly. The stablecoin.
Which brings us to the digital realm. And look, I know stablecoins have been around for a while, but the sheer scale of them today is just hard to wrap your head around. What are the actual numbers we are looking at in the research?
The scale is staggering. We are talking about digital tokens that are cryptographically pegged to the value of a U.S. dollar. By early 2025, the market cap for stablecoins was over $230 billion.
$230 billion, wow.
Yeah. And if you look at data from places experiencing heavy inflation, like Argentina, Stablecoins make up a massive 72% of all crypto purchases.
72%. Wait, really?
Yeah, people are opting for Tether and USDC over Bitcoin by a huge margin. About 50% Tether and 22% USDC. They don't want a volatile investment. They just want digital dollars they can use.
That makes total sense.
And in 2024 alone, Tether processed $10 trillion in transactions. That volume literally rivals Visa's $16 trillion.
$10 trillion. That is a fundamental shift in how the world moves money. But moving that much value digitally, second by second, introduces massive technical roadblocks.
Huge roadblocks, yeah.
Because the sources from Trezor highlight something called the Blockchain Trilemma. Break that down for me.
So the trilemma is a concept originally coined by the creator of Ethereum. It states that every blockchain network has three core pillars: decentralization, security, and scalability.
Okay.
The problem is, fundamentally, you can only optimize for two of them at the expense of the third.
Oh, so it's a pick two menu.
Precisely. Take Bitcoin, for example. It heavily prioritizes security and decentralization.
Right.
It relies on tens of thousands of independent computers globally to verify every single transaction, which makes it incredibly secure and tamper-proof. But the trade-off is scalability.
Because it's slow.
Right. The network adds data very slowly, so it's far too slow for everyday point-of-sale payments.
So the industry built alternative networks to be faster, like Ethereum and Solana. These are the highways where most of these stablecoins have been running, right?
They are. But those networks run into a completely different bottleneck. Ethereum and Solana operate on what computer scientists call a global shared state.
A global shared state. What does that mean?
Imagine a single massive ledger book that every participant in the world has to look at and agree upon before turning the page. Every node on the network has to update the sequential state of the entire system for every single transaction.
Wait. So if Solana and Ethereum are the main networks for stablecoins right now, but they suffer from this global shared state bottleneck where everyone has to wait in line to update the master record,
Yes.
how on earth are we processing trillions of dollars without the system catching fire?
Well, this raises an important question because the reality is the system kind of is catching fire, or at least it hit a massive wall.
Okay, that makes sense.
When you try to push global everyday microtransactions through a global shared state, it creates severe congestion. On Ethereum, that congestion historically led to astronomical spikes in transaction fees.
Yeah, you cannot ask a user to pay a $50 network fee to buy a $3 coffee.
Exactly. And Solana attempted to solve this by forcing parallel processing, but pushing a unified state that hard actually caused the entire network to crash multiple times. The current infrastructure is actually hitting a wall.
So they needed a fast lane.
Right. They needed a fundamentally different technical approach to handle global, everyday transactions.
And according to the technical breakdowns we have, that fix is the Lightning Network.
Yes. To solve the trilemma's traffic jam, developers built Layer 2 solutions. And the most prominent one discussed in these 2026 reports is the Lightning Network, specifically leveraging a new technology called the Taproot Assets Protocol.
Okay, stop right there. Taproot Assets Protocol sounds incredibly dense. Translate that for me and for the listener. What does it actually do?
In plain English, Taproot Assets is simply the software upgrade that allows you to take a stablecoin, like a digital US dollar, and issue it directly on top of the Bitcoin network.
Oh, interesting.
Previously, Bitcoin's network only handled Bitcoin. Now, it can handle digital dollars.
Got it. But wait, if Bitcoin is the slowest network of all, how does putting digital dollars on it solve the speed problem?
Because of the Lightning Network's off-chain channels.
Okay.
Instead of broadcasting every single transaction to the global network of miners and waiting for that slow, global shared state to update, two people can open a private channel between themselves.
So it's like a local agreement.
Exactly.
Mm-hmm.
They can transact back and forth thousands of times instantly with practically zero fees. They only interact with the main Bitcoin blockchain twice, once to open the channel and once to close it and record the final netted balance.
Okay, I think I have an analogy for this.
Let's hear it.
It is like keeping a bar tab open with a bartender all night.
Oh.
Instead of swiping your credit card for every single drink you order and backing up the line while the machine processes it, you just settle the final bill once at the end of the night.
That perfectly captures the mechanism. It solves the digital plumbing issue entirely. And because you are only updating the global ledger at the very end of the night, you can have millions of these bar tabs open simultaneously across the globe.
Wow.
You're processing millions of instant free transactions without burdening the main blockchain. You get the security and decentralization of Bitcoin combined with the scalability of off-chain channels.
That is brilliant. And this isn't just the theoretical tech bros stuff anymore. The research highlights a massive announcement from January 2025 in El Salvador, where Tether officially launched on the Lightning Network.
Right.
They took the biggest digital dollar in the world and put it on the fastest rails. And major corporate players are capitalizing on this. I mean, Cash App integrated Lightning, rolling it out to 4 million Square merchant terminals by 2026.
And the incentive structure for companies like Cash App is fascinating. They disclose they are earning massive yields, approaching 9.7%, simply by routing these Lightning payments.
Just for riding them.
Yeah, they're acting as the digital bartenders. They don't take on the risk of lending out money. They just provide the infrastructure to pass the digital dollars back and forth, collecting fractions of a penny on millions of transactions.
Here is where it gets really interesting, though, because as slick as that digital plumbing is, those digital dollars eventually have to interact with the physical world.
Right, exactly.
If you are a merchant using Square, you eventually want to cash out those digital tokens for real fiat dollars in a real checking account.
And that collision between hyper-fast crypto rails and traditional slow-moving banks is quietly causing a massive crisis in the banking sector.
We have a dense staff report from the New York Federal Reserve from February 2026 in the stack today, and it outlines how stablecoins are quietly breaking the banking sector.
It's a fascinating read.
It really is. The report identifies a new phenomenon called the liquidity channel of disintermediation. But they use some incredibly heavy financial jargon here. They talk about stablecoin issuers processing gross settled intraday redemptions. Explain that to me like I'm 5.
Sure. Let's compare it to something familiar, like a traditional mutual fund. When people buy or sell shares in a mutual fund all day, the fund managers wait until the market closes at 4:00 p.m.
You're right.
They tally up all the buys, subtract all the sells, and settle the net difference just once. That is net settlement.
So they only have to move the actual cash once a day.
Exactly. But stablecoin issuers operate under completely different rules. By law and by market demand, they promise timely redemption.
Timely redemption? Okay.
If a user wants to turn 500 million digital dollars into real cash at 10 Victor AM, the stablecoin issuer has to fulfill that immediately. If another user wants 200 million at 2:00 p.m., they fulfill it immediately.
Oh, wow.
Every single transaction settles individually throughout the day. That is a gross settled intraday redemption.
So instead of a predictable reservoir of money that slowly drains or fills once a day, the bank is dealing with a fire hose that could blast randomly at any second, demanding hundreds of millions of dollars.
Yes. And traditional banks are simply not built to handle that kind of unpredictable liquidity shock. The Fed report shows that when a bank partners with a stablecoin issuer, that bank sees a 67% increase in interbank Fed wire payments.
67%. That is a huge jump.
The volume of money whipping back and forth is unprecedented, and it is highly concentrated. The top 3 partner banks process 58% of all this transaction value.
So a tiny handful of traditional banks are taking the absolute brunt of these massive fire hose blasts.
Exactly.
So how does a bank survive that? I mean, if they don't know when a stablecoin company is going to demand $1 billion, how do they run their business?
They are forced into what economists call narrow operations. To survive these intraday payment shocks, partner banks have to hold billions in excess reserves.
Because they can't lend it out.
Right. The fundamental business model of a bank is fractional reserve banking. They take your deposits, keep a small fraction in the vault, and lend the rest out as mortgages or business loans to make a profit.
Yeah.
But if a bank is holding deposits for a stablecoin issuer, they cannot risk tying that money up in a 30-year mortgage. They have to keep the cash readily available.
They have to just sit on the money. The Fed data in our stack shows that for these specific partner banks, their loan-to-asset ratios plummeted by 14 percentage points compared to peer banks.
It's a massive drop.
Think about how wild this is for you listening right now. Banks are supposed to take your deposits and lend them out to make money. But let me push you on this. If these banks are hoarding cash and stopping lending just to handle stablecoin traffic, isn't crypto essentially starving the traditional credit market?
Yes, absolutely. If we connect this to the bigger picture, the total asset size of these banks looks great on paper because of the massive influx of stablecoin deposits,
Yeah.
but their actual economic function lending shrinks dramatically.
That is wild.
And to make matters even more complicated, following the 2023 banking crisis, the stablecoin issuers themselves realized commercial banks were actually a risk.
Wait, why would the crypto companies flee the banks? I thought the banks were the ones getting squeezed.
Well, when several key crypto-friendly commercial banks collapsed in 2023, stablecoin issuers realized that leaving billions of dollars sitting in an uninsured commercial bank deposit was a massive counterparty risk. If the bank fails, the stablecoin loses its backing.
Oh, wow. So the banks are stressed holding the money, and the crypto companies are stressed leaving it there.
Exactly. So the stablecoin issuers began aggressively pulling their reserves out of commercial bank deposits and shifting them into collateralized assets, specifically U.S. Treasury repos.
What's a repo?
A repo is essentially a short-term secured loan backed by U.S. government debt. It is considered one of the safest places on earth to park cash, completely bypassing commercial bank risk.
So you have banks hoarding reserves to handle the traffic they do have, while stablecoin issuers are draining billions out of the banking system entirely to buy treasuries.
Yep.
It's a systemic shift, and it forces central banks to completely rethink how they manage aggregate reserve demand in the economy.
When trillions of dollars start bypassing traditional banks and flowing instantly across borders, governments realize they are losing their grip on the steering wheel. They can't just sit back and watch.
No, they certainly can't.
Which perfectly explains why 2026 has become the year the rules are finally being written.
It really has.
We have a global regulatory guide from Skadden outlining the current landscape in the U.S. Now, as a quick reminder to you listening, the Skadden report mentions the second Trump administration's lighter touch regulatory approach and the goal to make the U.S. the crypto capital.
Right. And we are maintaining absolute political impartiality here. We are presenting this strictly as the factual regulatory environment currently driving market behavior.
Exactly. We just want to look at the rules of the road.
Yeah.
So the most critical piece of U.S. legislation in this stack is the Genius Act, signed in July 2025.
Yes. For the first time, it legally defines what a payment stablecoin is.
And it establishes federal standards, including mandating that exact timely redemption requirement that is causing so much stress on the banks. The OCC regulations are expected to drop this year, in 2026.
But the U.S. isn't the only player. The Bitwage source breaks down Europe's equivalent, MiCA, the markets in crypto assets regulation. And it is incredibly strict.
Very strict. It mandates a one-to-one liquid backing and par value redemption.
Yeah. But more importantly, if a stablecoin gets too big, if it's deemed significant, it gets stripped away from local regulators and falls under the direct supervision of the European Banking Authority.
So both the U.S. and Europe share the same underlying goal here, to drag stablecoins out of the shadow economy and force them to integrate with the regulated financial system.
But forcing legacy banks and crypto natives to play in the same sandbox is causing a massive turf war. I loved reading about this in the Skadden report, the fight over reward programs.
Oh, the reward programs? Yeah.
So under the new U.S. law, you cannot pay yield or interest directly on a stablecoin. If you do, the government classifies it as an investment security, not a currency.
Right.
But crypto companies want to attract users, so they get creative. They offer customer incentives or reward programs to circumvent the ban on paying yield.
And the traditional banks are furious about it. They are arguing that crypto companies are violating the Genius Act.
So traditional banks are basically tattletaling to the regulatory teachers about crypto reward programs.
That's exactly what they're doing. But the ultimate irony here is what the central bankers are doing behind closed doors. While commercial banks are fighting the crypto companies, the traditional financial system is quietly absorbing the tech. Look at the press release from the European Central Bank regarding Project Agora.
Right, I saw that. What are they testing?
The ECB is successfully testing wholesale cross-border payments using tokenized central bank reserves and tokenized commercial bank deposits.
They literally built their own blockchain. But how is that any different from a normal wire transfer between international banks?
Because of a concept called atomic settlement.
Atomic settlement.
Yeah. In a traditional wire transfer, messaging and settlement are separate. You send a message saying move the money, and then days later the actual funds settle through correspondent banks. It is slow and prone to failure.
Oh, right.
With atomic settlement on a blockchain, the payment and the settlement happen simultaneously and indivisibly. If one part of the transaction fails, the entire thing fails instantly.
So there's no waiting.
No waiting, no trapped liquidity. It operates exactly like a stablecoin zipping across the Lightning Network, but it is built, owned, and controlled entirely by the central banks.
That is wild. So traditional banks are tattletaling about crypto reward programs, while the central banks are just quietly copying crypto's homework with Project Agora.
Exactly. Regulation isn't killing crypto, it's just merging it with the legacy system.
Wow. Let's zoom out and look at the incredible journey we've taken today.
Mm.
We started with BerkShares, beautifully printed physical paper money in Massachusetts, trying to keep money local with penalties.
But physical paper doesn't scale.
No. So the internet ripped down the geographic borders, and we got stablecoins, moving trillions of dollars globally. When that volume bottlenecked, developers built the Lightning Network, acting like a giant digital bartender's tab to move cash instantly.
Which created a fire hose of unpredictable transactions.
Yes, transmitting massive liquidity shocks into the traditional banking system. It literally forced banks to hoard cash and stop lending to handle the sheer volume of digital cash. And now, regulators have stepped in to tame the Wild West while central banks quietly tokenize their own money.
It really is a quiet revolution.
It is. So what does this all mean for you?
Well, it means the fundamental nature of the money in your pocket, or rather, the money in your phone, is shifting beneath your feet. If local currencies use physical paper to bypass the global economy, and digital stablecoins use cryptography to bypass traditional banks, what happens when central banks fully tokenize their own currencies?
That's a great question.
In a future where the government controls the blockchain, does the promise of a decentralized financial revolution disappear? Or does it just become the new status quo? Think about that the next time you tap your phone to pay.